That is earnings roundup and stocks in the news. Now we're going to transition to another segment on Jedi Options, and Tyler Craig is going to be walking us through how to read a risk graph. And Tyler, I love risk graphs. Option traders love risk graphs. But I think everybody should embrace risk graphs. Stock traders, option traders, you name it. Put your portfolio on a risk graph to understand everything. Tyler, turning it over to you for another edition of Jedi Options from Tackle Trading.
So I'm feeling artistic today. I wanted to draw some pictures, and risk graphs might be the most fun picture to draw when it comes to option trading. And this isn't a concept that only applies to a few people or a few strategies. Risk graphs are integral to learning how to trade options. And so if you want to learn how to trade options, this is a tool that is essential. Like, you have to learn how to use this tool, just like learning how to read an options chain. So we're going basic. We're going basic today. I use risk graphs all the time. And so let me give you a breakdown. They're not that hard. They're not that hard. My goal today in the next 10 minutes is to get you where you think these are just, easy as pie and you understand how to use them. Before I go to the actual tool on a platform like Thinkorswim, I want to give you the lay of the land here. And we're going to start with a stock trade to keep it easy. Okay, so in a risk graph, there is an X and a Y axis, a vertical line and a horizontal line. And sometimes the horizontal line's at the bottom, like a little table, but we're going to put it in the center here. And essentially, you got to get what your different axes represent. So on the left, you've got profit on the top, you've got loss on the bottom, and then in the middle, that horizontal line just represents zero or the break even. So if your graph is above that, you're making money. If you're below that, you're losing money. Very simple. And then the horizontal axis, so the vertical is profit and loss. The horizontal is representing the stock price, right? The stock price. And so as we move right or left, right, as we go this way or we go this way, you're manipulating the stock price to see what impact it has on your trade. So the beautiful thing about a risk graph, if we back up a step, why do we use this? We use this because you can model your trade. You can do a what if scenario and see how much money you're going to make. It doesn't have to be guesswork. It doesn't have to be a question mark. You can build a trade, stock or options. You can look at it on a risk graph and you can say, what if the stock goes up 5%? How much money am I going to make? What if the stock goes down to support? How much money am I going to lose? You can map out these what if scenarios so that you know the potential outcomes so you can make an informed decision. And it even gets better than that because there's multiple variables when you go to the options market. Stock price is just one, but time passing, volatility changing, those are other variables that you can change on the graph to see the impact it has on your trade. And so ultimately, banks often use the term stress test. Like the Federal Reserve, they did a stress test on the banks, make sure they had enough money, make sure they had enough collateral to withstand an adverse environment. Like what if 10% of the loans on your book default? Can you survive that? Stress testing a bank's balance sheet is done so that they know they can survive adverse scenarios. You could stress test a position using a risk graph. So when you understand the tool, you're going to be able to say, oh, what if this moves favorably? What if this moves unfavorably? Can I survive that? What's the impact? When banks do stress tests, it allows them to better understand their business and where they're at financially. When you stress test your option positions using a risk graph, it's the same outcome. You're going to better understand your portfolio and the types of risks you have and how to handle those. So that's why this can be helpful. To say nothing of the fact that this can help you know how many contracts to do or how many shares to buy. So from a risk management and position sizing perspective, we use graphs to figure out, oh, I can do 3 contracts or 5 contracts or 10 contracts, and I know what the risk is, okay? All right, so that's the lay of the land. Now let's map out a trade or two and show you what it would look like. Okay, I'm gonna take these arrows off here. Let's say this is a long stock trade. Very simple, I'm gonna buy stock. Well, let's say I buy the stock for 50 bucks. So 50 is here. That's my purchase price. Usually we're going up in value over to the right. We're going down in value over to the left. And when I say usually, I mean every time. That's the way it's laid out. So what is my break even? Well, my break even would be 50 bucks. So that's where this risk graph would cross the zero line. And if the stock goes up, I should be making money. And so my risk graph would be going up over here. And if the stock goes down, I would be losing money. So my risk graph would go into the negative territory. So essentially, if you do that all at once, it's a 45-degree line from bottom left to top right. That's what a stock trade looks like. And when you're in the profit zone, they're going to shade this area green. You can just think of it that way. And then the area on the left underneath zero would be the amount of loss. And so then you could say, oh, well, if the stock goes up to $60, let's see where $60 intersects my risk graph. And then you can look at the corresponding profit on the left. And if you own 100 shares, the stock went up $10. So it would show you that you made $1,000, right? Or you could over on the left, you could say, what if the stock goes down to 40 bucks? You could see where that intersects your graph and look at the corresponding loss. And in this case, it'd be about $1,000 loss. Okay, so that's a long stock position. And you might think, well, that's pretty straightforward because my profit and loss, they come linearly. Like I make dollar for dollar as the stock goes up. I lose dollar for dollar as the stock goes down. So maybe if you can do that in your head, you don't even need a risk graph. And oftentimes stock traders decide not to use a risk graph because they can do this with a calculator. Where it gets complicated though is in the options market. It's not so straightforward because there's a lot of different variables. And so if instead of buying a stock, I bought a call option and I wanted to model that out, let's say that I bought a 50 strike call and I paid $3. Well, just knowing what we know about call options, your risk is what you paid. So the max loss or the max risk would be $3 or $300 per contract. And then the potential reward would be unlimited, right? Potential reward would be unlimited. So let me fix that. So when you look at the risk graph, if the stock's at $50 here or 40 or 60, well, below 50 bucks at expiration, this call isn't worth anything. So I know I could lose $300 if the call expires worthless. And that will happen if it's out of the money, which by the way, out of the money's over here, in the money's over here. If we're below 50, I'm going to lose 300 bucks. If we start to get above 50, the call has value at expiration. And the higher the stock goes, the more money I make. Incidentally, the break even on this would be 53 because your call needs to be $3 in the money to recoup your cost. But this is the shape of a long call option on a risk graph. And it has similar characteristics to long stock. It effectively is long stock if it's in the money, but if it goes out of the money, you can't lose anymore. And so there are similarities here. It's like, hey, if you like the upside of stock, but you don't like all the downside, how about you buy a call option? You've got similar upside, but you have limited downside. Well, me saying that, you may think, I don't understand what you mean. But when I show you visually on a risk graph, it's easier to grasp the difference, right? So you can imagine if you learn the risk graph of each option strategy, you're going to have a much better idea of what the heck's going on. Okay. So we teach these risk graphs as a complement to understanding the numbers and the theory and the philosophy behind each option strategy. And then in your mind, you start to attach a picture to each different strategy. And they're all somewhat unique, and you get to the point where you can say, oh, this is a long call. This is a long put. This is a call vertical spread. This is an iron condor. And so these shapes tell you something about the characteristics of the trade, what you want to happen. If I did a 30-minute little video here, we could get into position sizing and doing more in-depth what-if scenarios. But my main objective today was to help you understand the x-axis, the y-axis, profit, loss, stock price, being able to understand which way the stock's moving and if you're getting a profit or a loss. consider this just a quick introduction to the basics of a risk graph. The next step is for you to actually go play with these, get some hands-on experience, maybe watch some of the other videos we have at Tackle Trading. But anyways, these are risk graphs, and that's the lesson for today.